The AI industry was sold as progress. Instead, it just detonated the most dangerous economic chain reaction in 20 years. Overnight, algorithms began erasing the very workers who keep America's credit system alive. Six-figure earners with giant mortgages, perfect credit scores, and the spending power that props up 70% of the US economy. These weren't the people anyone expected to fall, which is exactly why their collapse is so explosive. Because when prime borrowers get pushed off a financial cliff, the entire system built on their stability begins to shake. Credit markets, housing, Wall Street, even the dollar itself. The AI revolution didn't create efficiency. It created vulnerability that triggered next biggest economic crash. The first fractures in the economic foundation appear where no one ever expected, the upper tiers of the workforce. AI isn't nibbling at the edges of low-wage labor. It is slicing through the occupations that once defined financial stability in America. The people losing their jobs today are the ones carrying $600,000 mortgages, $1,200 monthly car payments, and multi-thousand-dollar household budgets that collapse instantly when income disappears. The scale of removal is unprecedented. Over 1 million job cuts this year didn't come from retail counters or factory floors. They came from corporate offices, financial departments, consulting firms, HR divisions, and analytical roles that were once insulated by expertise and credentials. Automation has become the blunt instrument corporations deploy to remove entire layers of middle and upper middle management. These positions aren't being replaced or outsourced, they're being erased. A line of code now performs what once required a trained employee earning $95,000 to $180,000 a year. For the companies implementing AI, this means efficiency. For the financial system, it means the sudden destabilization of the borrowers most responsible for credit expansion, mortgage demand, auto financing, and discretionary spending. Worse, this displacement is not temporary. Surveys from Fortune 500 firms show that over 40% are actively restructuring their organizations around AI models, permanently reducing the need for white-collar labor. Even companies reporting strong earnings are cutting headcount, signaling that this is not recession-driven. It is structural. That distinction matters because structural layoffs do not reverse when conditions improve. The job simply ceases to exist. As high earners vanish from payrolls, the ripple effect spreads quickly. These workers carry some of the largest financial obligations in the country. When their income stops, credit stress accelerates upward through the economy, triggering the very instability the middle class once shielded the nation from. This is why the AI-driven layoff wave is more than a workforce transition. It is the first mechanism pulling pressure into the financial tier responsible for nearly half of all consumer spending. The shock begins with lost jobs, but what follows next will determine whether the credit system can sustain a blow it has never confronted before. The removal of high-income workers does more than shrink payrolls. It flips the risk structure of the entire financial system. When the workforce segment carrying the largest financial obligations loses stability, lenders are forced into a scenario they never modeled. Prime borrowers were always treated as the unshakable tier. Predictable earners with consistent repayment patterns, the group underwriting depends on to offset losses elsewhere. But that classification collapses the moment their income stream is disrupted. The earliest signal emerged in lending data, not employment reports. High credit households began tapping short-term financing tools at rates previously associated with lower income brackets. This shift wasn't tied to discretionary purchases. It was tied to recurring bills. For lenders, this is a red flag event because these borrowers historically maintained wide financial buffers. Their balance sheets reveal why the system becomes unstable so quickly. Prime households operate with monthly commitments often surpassing $6,500 to $9,000, built around mortgages, multi-year financing agreements, structured insurance plans, and personal credit lines calibrated to high, uninterrupted earnings. These structures work only as long as income remains constant. When employment falters, there is no gradual decline. Obligations exceed liquidity immediately. This is where risk models begin to break. Utilization levels among top-tier cardholders have risen enough to trigger internal alerts within major financial institutions. Early-stage delinquencies, though still modest, are climbing at a rate inconsistent with historical patterns for this credit class. The shift is not occurring because borrowers are irresponsible. It's occurring because the financial architecture that classified them as low risk never accounted for synchronized job removal within their income tier. The consequence is a rapid repricing of risk at the top of the credit spectrum. Once prime borrowers begin to resemble a category the system has no framework for. Individuals with excellent credit histories but sharply deteriorating financial capacity. This transition forces lenders, markets, and policymakers to reassess assumptions that have held for decades. And with the strongest borrowers losing stability, the system's margin for error narrows faster than the models were ever built to accommodate. As lenders begin reassessing the stability of prime households, the next layer of distortion appears in the labor data itself. The official unemployment rate paints a controlled picture, but it no longer reflects the structure of the modern workforce. The headline 4.4% figure counts only those who are fully jobless and actively searching. It excludes every category that reveals how deeply the labor market has fractured beneath the surface. The first distortion comes from workers forced into part-time roles after losing full-time employment. This group has expanded sharply as companies replace entire departments with automated systems and AI-driven workflows. A position once earning $80,000 to $120,000 is often replaced with a part-time role paying under $25 an hour, stripping households of thousands of dollars in monthly income while still categorizing them as employed. A second distortion comes from workers holding multiple low-paying jobs to approximate the income of a single previous career. This population has surged across urban and suburban markets, particularly among those with substantial monthly obligations. They appear fully employed on paper, yet their combined income is often insufficient to sustain mortgage payments, insurance costs, transportation expenses, and rising utility bills that can easily total $3,000 to $4,000 per month. Then comes the group no longer captured at all, individuals who have stopped looking for work because their field no longer exists in its previous form. AI-driven consolidation has eliminated roles permanently, not cyclically. When workers stop searching after months of unsuccessful attempts, they vanish from official reporting, despite having no meaningful income. When all three categories are included, involuntary part-time workers, multi-job earners replacing lost salaries, and displaced professionals who have exited the search pool, the functional unemployment rate approaches 1 in 4 Americans. This broader measure exposes a labor market far weaker than the headline number suggests, and reveals why financial stress is accelerating even among workers who appear employed. This misalignment between reported strength and actual conditions is not a statistical quirk. It is a structural failure in how economic health is measured. A workforce experiencing fragmentation at this magnitude cannot support stable credit markets, predictable lending behavior, or consistent consumption patterns. As traditional indicators mask the deterioration, the system drifts further from reality, setting the stage for pressure to emerge where neither policymakers nor lenders are prepared to absorb it. The distortion in employment data becomes far more consequential once it meets the financial reality households are carrying. The U.S. consumer now sits on $18.6 trillion in total debt, the highest level ever recorded. And the structure of that debt leaves little room for economic strain. Every major category has expanded simultaneously. Mortgages exceeding $12 trillion, auto loans approaching $1.6 trillion, credit card balances setting new highs above $1.1 trillion, and personal loans growing as families attempt to fill widening gaps in monthly budgets. What makes this moment uniquely fragile is the compression between rising obligations and declining financial capacity. Interest rates on revolving credit have climbed to levels unseen in modern history, with the average credit card APR surpassing 22%. A household carrying just $10,000 on a card now faces over $2,000 a year in interest alone, a cost structure that rapidly accelerates delinquency when income becomes unstable. Auto debt adds another layer of pressure. Monthly payments for new vehicles routinely exceed $725, with longer loan terms stretching past 70 months. The financial risk compounds as used car prices correct downward, erasing equity and leaving borrowers exposed to balances larger than the value of the vehicle. Mortgage stress is rising as well, particularly among homeowners who purchased during the price surge of 2020 to 2022 and locked in obligations close to the top of their affordability range. These pressures converge into a single outcome. The margin between stability and default has evaporated for tens of millions of households. Even minor disruptions, medical expenses, temporary job reductions, or higher utility costs can convert a balanced budget into a deficit within weeks. Recent data reflects this tightening. Credit card delinquencies have climbed towards 7%, a trajectory historically associated with pre-crisis conditions. This strain does not occur in isolation. A consumer base carrying record debt with shrinking financial bandwidth becomes increasingly vulnerable to shifts in employment, interest rates, and credit availability. The economic engine that once depended on broad, resilient consumer spending now operates under a different reality. Households are leveraged to the point where any additional pressure risks destabilizing their ability to meet obligations. As these financial limits are reached, the broader system must confront the consequences of a consumer economy functioning at the edge of its capacity. As household debt pushes toward its upper limit, the earliest fractures surface in the sector historically most sensitive to economic tension: auto lending. Vehicle financing reacts to stress faster than mortgages or credit cards because it sits at the intersection of rising prices, high interest rates, and borrowers with limited flexibility. The result is a rapid deterioration in subprime performance that now exceeds anything seen in more than a decade. 60-day delinquencies in subprime auto loans have climbed past 6.6%, reaching levels associated with periods of severe financial strain. Repossessions are rising sharply, with annual projections approaching 3 million vehicles, a volume large enough to disrupt both lenders and the used car market simultaneously. These aren't isolated cases. They demonstrate a structural imbalance. Borrowers entered long-term loans at elevated prices, then faced payment schedules that outpaced their income capacity as inflation pushed essential living costs higher. The pricing dynamics of recent years magnified the risk. During the supply shortages of 2021 to 2022, used car values soared to historic highs, and many subprime borrowers financed vehicles at inflated amounts with interest rates exceeding 13% to 20%. As inventories normalize and prices decline, millions of borrowers now owe far more than their cars are worth, erasing the financial cushion that once prevented rapid default. When the asset backing the loan holds less value than the balance owed, repossession becomes the lender's only logical path, and the borrower's immediate financial collapse. The consequences extend beyond the subprime category. Rising losses force lenders to tighten underwriting standards, reducing available credit across all tiers. Higher-income borrowers who previously faced near-automatic approval now encounter stricter evaluations, higher rates, or reduced loan amounts. This contraction feeds back into the broader economy. Fewer approved buyers mean reduced vehicle sales, slowing dealership revenue, manufacturer output, and associated employment. The subprime auto breakdown is not the crisis itself. It is the earliest measurable indicator that consumers can no longer absorb additional financial strain. It signals diminishing tolerance in household budgets, already stretched by rising debt obligations and inconsistent income. In every past downturn, auto delinquencies were the first financial metric to turn sharply negative before broader pressures emerged. The current trajectory shows the same pattern, only faster and more pronounced, revealing how little resilience remains in America's most vulnerable borrowers and how quickly that weakness transmits through the credit markets that depend on them. The deterioration in subprime auto lending exposes the weakest households, but the greater structural danger lies at the opposite end of the financial spectrum. The U.S. economy has become increasingly dependent on a narrow segment of high-income earners, creating an imbalance that magnifies every shock above or below it. Consumer spending drives nearly 70% of GDP, Yet almost half of that activity now comes from the top 10% of households. This concentration fundamentally alters how economic pressure moves through the system. The mathematics behind this shift is stark. Decades of wage stagnation for the majority of workers, combined with asset inflation benefiting top earners, have widened purchasing power to an unprecedented scale. A household earning $250,000 contributes far more to aggregate demand than multiple middle-income families combined, not only through discretionary spending but through higher mortgage payments, investment activity, and credit usage. When this minority shoulders such a disproportionate share of economic circulation, the system becomes hypersensitive to any disruption affecting them. The surge in layoffs among white-collar employees directly intersects with this imbalance. These earners support industries that depend on consistent high-level spending: travel, hospitality, technology, real estate, financial services, and luxury retail. Even a modest pullback from this group can contract revenue streams across sectors that rely on higher-margin customers. Early signals already show softening in discretionary categories, typically insulated from economic downturns. Indicators that rarely shift unless top-tier households adjust their behavior. This concentration also reshapes credit dynamics. Lenders have structured entire portfolios around the reliability of higher-income borrowers, issuing larger mortgages, premium credit lines, and multi-year financing packages based on the assumption of income durability. When stability in this segment weakens, the ripple effect on lending capacity becomes immediate. Tighter credit conditions emerge not only because of rising risk, but because financial institutions cannot afford deterioration within the group that generates the bulk of repayment revenue. A consumer economy anchored to a thin layer of affluence lacks the broad resilience that historically softened downturns. When the spending power of the majority declines and the participation rate narrows, the system becomes a tower relying on fewer structural supports. Any strain at the top carries disproportionately large consequences, reducing the buffer that once allowed the U.S. economy to absorb shocks without rapid contagion. The imbalance is no longer an abstract inequality issue. It is a mechanical vulnerability that shapes how financial stress spreads through every sector tied to consumer demand. Once economic dependence concentrates around a small, high-income segment, any reduction in their spending triggers pressure in the three markets most sensitive to affluent behavior: housing, equities, and corporate credit. These aren't peripheral areas. They form the backbone of U.S. wealth creation, retirement security, and business financing. When top earners adjust their financial posture, these pillars react long before official data reflects instability. Housing absorbs the first wave. The upper tiers of the market rely heavily on buyers with strong credit, sizable down payments, and the ability to sustain monthly obligations exceeding $3,500 to $5,000. When this group becomes cautious or loses income, demand at these price points thins rapidly. Listings remain active longer, price reductions become more frequent, and sellers who purchased near-peak valuations face compressed equity positions. This shift matters because higher-end transactions support a wide ecosystem: construction firms, lenders, insurers, appraisers, and local tax bases. Reduced participation by top earners constricts that entire chain. The equity market exhibits a similar sensitivity. A significant share of stock ownership is concentrated among high-income households, which means their investment decisions carry disproportionate weight. Even modest reductions in contributions to retirement accounts or brokerage portfolios can influence liquidity, especially in sectors already trading at elevated valuations. When these investors pull back, momentum weakens and volatility increases, amplifying market reactions to earnings misses, rate expectations, or geopolitical events. With indices heavily dependent on a handful of mega-cap companies, changes in affluent investor sentiment translate into broader instability. Corporate debt forms the third pressure point. Companies rely on predictable consumer behavior to service their obligations, particularly firms operating with narrow margins or substantial refinancing needs. When high earners reduce spending, revenue in discretionary sectors declines first, weakening their ability to meet interest costs. This is especially dangerous in an environment where trillions in corporate debt must roll over at higher rates. A shift of even a few percentage points in high-income consumption can alter debt servicing capacity enough to trigger credit rating downgrades or restructuring events. Each of these cracks arises from the same structural condition. A small, financially powerful segment of the population now carries an outsized share of national economic activity. When their financial stability wavers or their behavior changes, the system loses the reinforcement that once distributed risk more evenly. Housing begins to soften, markets grow more reactive, and corporate obligations become harder to sustain. All emerging quietly, then accelerating as the imbalance tightens. As cracks emerge across housing, equities, and corporate debt, the pressure inevitably shifts to the institution responsible for stabilizing the system, the Federal Reserve. The signals are now unmistakable. Balance sheet reduction has stalled, liquidity operations have expanded, and policymakers have begun preparing the public for an environment where tightening is no longer feasible. The abrupt end of quantitative tightening marks a critical turning point. It indicates that the financial structure cannot withstand further drainage without triggering broader instability. The strain is visible in funding markets. Treasury auctions have shown weaker demand from traditional buyers, pushing yields higher and increasing borrowing costs for the government and private sector alike. With over $8 trillion in treasuries needing refinancing within the next 24 months, even minor disruptions in demand create cascading effects across interest rates and credit conditions. The Fed, aware of these vulnerabilities, is compelled to intervene, not because economic fundamentals are improving, but because inaction risks a liquidity shortage capable of freezing lending activity. Reintroducing asset purchases becomes the predictable response. Whether described as balance sheet stabilization, market support, or temporary liquidity management, the mechanism functions the same: the creation of new dollars to absorb financial stress. But injecting liquidity into a system already carrying elevated prices reignites the very force policymakers claim to have contained. Inflation reemerges not through consumer exuberance, but through monetary expansion intersecting with constrained supply and fragile household budgets. This creates a dual hazard. Financial markets receive short-term support, preventing immediate breakdowns in leveraged sectors, yet the purchasing power of everyday Americans deteriorates further. Rising costs for essentials compress disposable income, intensifying pressure on households already struggling to meet obligations. Higher prices feed back into wage demands, production costs, and service pricing, making inflation more persistent than before. The Fed faces a narrowing set of options. Rates cannot climb without worsening corporate defaults. Quantitative tightening cannot resume without destabilizing treasury markets. And continuing liquidity support ensures ongoing devaluation of the currency. The institution designed to manage stability now confronts conditions where every tool it deploys generates collateral damage. The pivot away from tightening is not a strategic adjustment. It is a signal that the system has reached a level of fragility where maintaining normal policy risks accelerating the downturn it seeks to prevent. The moment the Federal Reserve pivots back toward monetary expansion, the consequences extend far beyond domestic markets. Global institutions, foreign governments, and reserve managers watch the shift closely because U.S. policy decisions define the stability of the world's largest financial ecosystem. When the dollar supply expands in response to internal stress, it raises questions about durability, reliability, and long-term purchasing power. Those questions are now reshaping international behavior. Foreign demand for U.S. treasuries has already weakened. Major holders, including China and Japan, have reduced exposure in recent years, collectively trimming hundreds of billions from their portfolios. This decline is not sudden but stems from strategic reassessment. Rising geopolitical tensions, concerns over sanctions being used as financial weapons, and the recognition that the U.S. debt load, now exceeding $34 trillion, requires perpetual refinancing. When the Federal Reserve signals that sustained liquidity injections may be necessary, the risk calculus changes further. Investors must account for potential long-term erosion in real returns. This environment encourages diversification. Nations are increasing gold reserves at the fastest pace in decades, a deliberate movement away from dollar dependence. Trade alliances across Asia, the Middle East, and parts of Africa are exploring settlement mechanisms that reduce exposure to U.S. financial infrastructure. Even if these alternatives are imperfect, their existence marks a shift in global strategy. Prepare for an era where the dollar's dominance weakens gradually rather than collapses abruptly. Geopolitical tensions intensify the pressure. Conflicts in energy-producing regions, trade disputes involving multinational supply chains, and sanctions deployed across financial networks create incentives for countries to build parallel systems. As reliance on the dollar becomes more of a strategic vulnerability, responses become more coordinated. Every incremental move, whether the creation of currency swap lines, regional payment platforms, or agreements involving commodities-backed trade, adds weight to the long-term transition. The U.S. remains the central node of global finance, but its resilience depends on confidence. When domestic policy and structural fragility force repeated interventions, that confidence erodes. International actors interpret the shift back to monetary expansion not as a controlled adjustment, but as a signal that internal pressures outweigh stability objectives. As trust weakens, alternatives accelerate, and the financial empire that once functioned with unquestioned authority begins to confront the reality of a world preparing for reduced dependence on a single currency. All the pressures building across labor markets, household finances, asset sectors, Federal Reserve policy, and global positioning converge into a single unavoidable conclusion. The next phase is no longer about isolated stress points, but systemic fragility. A credit system depends on confidence, liquidity, and predictable repayment behavior. Each of those pillars is now under strain. High-income earners, once the stabilizing force, face shrinking job security. Households operate at the limit of their debt capacity. Asset markets rely on valuations disconnected from real economic strength. And the central bank's primary tool for crisis management, creating more liquidity, simultaneously weakens purchasing power and international trust. This convergence doesn't produce a sudden collapse. It produces a tightening cycle where credit becomes harder to obtain, lenders adopt defensive postures, and businesses struggle to fund operations or refinance obligations. As borrowing costs rise and risk spreads widen, weaker sectors break first, followed by companies and households that once appeared insulated. The shift from stability to instability is mechanical, not psychological. Once the structural supports weaken, the system adjusts downward until it finds a level where debt, income, and liquidity can coexist again. The foundations didn't fail overnight. They were eroded piece by piece. And now the consequences move faster than the systems built to contain them.